Welcome to vTalkInsight Allocators Lens Daily for January 8th, 2026. Cross-asset markets are leaning risk on, with equities, credit, and even crypto drawing flows, while rates markets price a gentle disinflation and central bank easing path. At the same time, rich valuations, geopolitical flashpoints, and shifting commodity signals mean the balance of risks is becoming more nuanced for portfolio allocators. In equities, the dominant message is still resilience, but it is no longer just a mega-cap technology story. U.S. benchmarks have pushed to new highs, with gains extending beyond chip makers into small caps, financials, industrials, energy, materials, healthcare, and transports. That breadth points to genuine risk appetite and a market that is willing to underwrite a soft landing narrative rather than simply crowding into a handful of growth names. Cyclical midcaps and the Russell 2000 leading at the start of the year reinforce that shift toward more economically sensitive exposure, even if on some days megacap tech still does much of the index heavy lifting. The artificial intelligence theme remains central, yet it is evolving. AI is now influencing margins and capital allocation across almost every S&P sector, from financial services to healthcare and consumer staples, not just the obvious hardware and cloud platforms. Many companies are prioritizing automation and efficiency investment over hiring, which supports earnings even as headline job growth slows. Within semiconductors, demand for high-performance memory and storage is surging, with some manufacturers reportedly planning price increases of 60 to 70% this quarter, and related stocks have rallied sharply before pausing to digest supply bottleneck headlines. Importantly for allocators, earnings in many AI-linked baskets have grown fast enough that valuation multiples have actually compressed, suggesting fundamentals have been catching up with prices rather than the other way around. At the same time, the memory and storage industry is still inherently cyclical, and current strength is expected eventually to face a downturn as new supply comes online and the cycle matures. That means the market is balancing a case for more secular, data center-driven growth against the reality that no hardware cycle is permanent. The breadth of AI beneficiaries, from industrial automation to autos and robotics partnerships, helps diversify that risk but does not eliminate sensitivity to a pause in infrastructure spending. The equity optimism rests on a macro backdrop that still looks soft landing friendly. Productivity has improved, wage growth is moderating, oil and gasoline prices are acting as a tax cut for consumers, and markets expect the Federal Reserve's next move to be a cut rather than a hike, even if the pace of easing is debated. Set against that, a cautious allocator cannot ignore valuation and concentration risk. Index-level multiples are elevated and assume that productivity and AI-linked earnings deliver on ambitious forecasts. Cyclicals and industrials that have led the recent rotation are not cheap, even though purchasing manager surveys remain mixed. U.S. portfolios are heavily skewed toward domestic equities and particularly semiconductors, so any air pocket in that complex could have outsized impact on wealth. Traditional hedges, such as volatility indexes and index options, have been less reliable as volatility stays subdued and drawdowns are quickly retraced, which is one reason gold is gaining mindshare as a hedge against geopolitical tail risks. For equities, incoming labor data, revisions to earnings expectations in cyclicals and AI beneficiaries, and the behavior of long-dated yields are likely to be the key signposts for how durable this risk-on phase proves to be. Turning to rates, government bond markets are telling a more cautious and disinflation-focused story than equities. Yields in the U.S. and Europe have been edging lower, with 10-year yields down a few basis points and the curve sitting at relatively low levels. That move aligns with incoming data that broadly support the idea of easing price pressures. Core inflation in the euro area has surprised slightly on the downside. U.S. wage growth is moderating, and consensus for upcoming payrolls points to only modest job gains. Lower oil prices, helped by additional supply coming from Venezuela, reinforce that disinflation trend and support expectations that central banks will eventually be able to move policy away from restrictive settings. Market pricing points to a gentle easing cycle, with investors looking for the Federal Reserve to begin cutting around mid-year and for other central banks, including the European Central Bank, to follow. The shape of the U.S. curve, where 10-year yields have risen relative to 2-year yields over recent months, is consistent with expectations that policy rates will move down from current levels while longer-term yields settle somewhat higher than the most aggressive dovish scenarios implied last year. Even so, some fixed-income specialists argue that the easy money in duration has been made, especially at the front end, and see limited room for further yield declines without a more pronounced economic slowdown. There are also non-trivial upside risks to yields that remain important for cross-asset allocators. Persistent fiscal deficits, a substantial planned increase in defense spending, and large capital expenditure needs around AI infrastructure could all put upward pressure on long-term rates or term premia over time. One scenario highlighted as a potential surprise is an increase in long-dated yields toward year-end if inflation proves stickier than current disinflation narratives assume, triggering a liquidity squeeze across leverage strategies. That possibility helps explain why bond markets appear more skeptical about an imminent growth rebound than equity markets. For multi-asset portfolios, the key signals and rates are the path of realized inflation, the tone of central bank communication on the pace and depth of cuts, and what the curve is saying about whether soft landing expectations remain credible. Credit sits at the intersection of the optimistic equity story and the more cautious bond market signal. In public markets, spreads remain tight even as corporate issuance has surged, suggesting borrowers are keen to lock in funding while investor demand for yield stays solid. Bank lending data shows sustained loan growth over recent weeks, which lines up with a narrative of ongoing economic expansion rather than an imminent credit crunch. At the same time, some fixed-income investors describe value as limited at current spread and yield levels, especially in higher quality segments where front-end rates have already moved lower. The picture is less benign in parts of private credit. Recent moves by a large manager to raise withdrawal limits on a retail-oriented private credit fund, following elevated redemption requests, brought liquidity risk in that space back into focus. Managers are under pressure to honor redemptions without being forced into distressed asset sales, and the underlying illiquidity of private loans remains a structural feature rather than a temporary bug. Commentators flag this as a particular concern for non-institutional investors, who may not fully appreciate the trade-off between higher yields and the ability to access capital quickly during periods of stress. Traditional banks, meanwhile, continue to adapt. Improved regulatory clarity is helping to restart bank merger and acquisition activity after several quiet years, and a gradual consolidation trend is expected to leave fewer but stronger regional institutions. That may support credit creation but also concentrates risk in a smaller number of balance sheets. Policy proposals around housing, such as restrictions on institutional single-family rental purchases and new wealth taxes, add another layer of uncertainty for specific issuers rather than the system as a whole. Overall, credit markets currently send a message of ample liquidity and confidence in corporate balance sheets, but the combination of tight spreads, heavy issuance, and emerging private credit strains means funding conditions will be watched closely for any sign of deterioration. In foreign exchange, the dominant questions are the trajectory of the U.S. dollar and how quickly alternative stores of value are becoming institutionalized. After a very sharp decline last year, many expect any further dollar weakness in this cycle to be more gradual. The dollar's yield advantage has narrowed as other central banks catch up and global growth becomes more broadly distributed. Yet sustained appreciation still appears to require the Federal Reserve to cut more aggressively than currently anticipated and for U.S. growth to slow meaningfully. In the near term, geopolitics and safe haven flows are giving the dollar some support. Tensions involving major powers, including debates over European security arrangements and unresolved conflicts in Eastern Europe, have raised risk premia around the euro, particularly given reports of crowded long positioning. Investors describe U.S. rates and headlines around diplomatic flashpoints as the primary drivers of eurodollar moves. Over a longer horizon, however, fiscal expansion in Europe and potential policy shifts in Japan could make non-U.S. assets more attractive, and a gently weaker dollar would tend to favor international equity holdings and emerging markets, all else equal. The other important development for allocators is the continued convergence between FX and digital assets. Major institutions have started filing for exchange-traded funds linked to Bitcoin, Ethereum, and Solana, signaling growing comfort with crypto exposure despite recent price volatility. At the infrastructure level, firms building compliant payment and settlement networks have raised substantial capital and accumulated regulatory licenses across multiple jurisdictions. Stablecoins, in aggregate, now hold a treasury bill portfolio comparable to that of a mid-sized sovereign, effectively extending the global reach of the U.S. dollar in digital form. Taken together, these shifts suggest that currency exposure is no longer just about traditional spot and forwards, but also about how quickly tokenized and crypto-native instruments become part of the mainstream toolkit. Commodities round out the macro picture with a mix of disinflationary signals and signs of structural tightness. In energy, crude prices have been under pressure, with U.S. benchmarks trading in the mid-50s per barrel after news of significant Venezuelan shipments and a partial easing of sanctions. Additional barrels headed to U.S. refiners configured for heavy sour crude help keep the global market comfortably supplied in the near term. Cheaper oil and gasoline effectively act as a tax cut for households and reduce headline inflation, reinforcing the bond market's disinflation message and supporting the soft landing narrative. However, today's low prices also highlight longer-term risks to supply. Years of underinvestment and persistent capital discipline among producers mean that current price levels are approaching unattractive break-evens for fresh projects. While some official commentary suggests the global oil market can absorb Venezuelan disruptions without much price impact, the combination of selective sanction enforcement, logistical bottlenecks, and geopolitical frictions makes the supply chain more fragile over time. That tension between near-term oversupply and medium-term capacity risk is a recurrent theme across the energy complex. Industrial and precious metals tell a different story. Copper prices have surged on the back of tight mine supply, U.S. stockpiling ahead of possible tariffs, and strong demand from energy transition projects, data centers, and grid infrastructure. The market is currently supported by genuine supply deficits and inventory concentration in the U.S., but there's a clear downside risk if planned tariffs do not materialize and large stockpiles are released back onto the global market. At the same time, gold continues to attract both official and private demand as central banks diversify reserves away from the dollar and investors seek hedges that have worked better than volatility products in recent shocks. Elevated prices for copper, lithium, and electricity underscore the scale of investment needed for electrification and AI infrastructure, reinforcing the idea that real assets sit at the crossroads of growth opportunity and inflation insurance. Stepping back, the cross-asset message today is of markets that remain firmly risk-on, but with a more complicated set of balances underneath. Equities are pricing a benign mix of AI-driven productivity, steady growth, and eventual policy easing, while rates markets emphasize disinflation and leave only limited room for error on inflation or deficits. Credit still looks open for business, yet private vehicles are reminding investors that liquidity is not free. The dollar and digital assets are both evolving as stores of value, and commodities blend short-term disinflation from oil with structural tightness in metals and power. For allocators, the most important signals to track are the interaction between labor data, long-dated yields, and earnings delivery in the cyclicals and AI complex, alongside any escalation in geopolitical tail risks that could reprice hedges, FX, and commodities together. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.